I'm at Research Market Insights video for June 15th. Hey, everybody, Willie Dowitch here. Glad you have tuned in. We had a Fed meeting yesterday. We've had inflation and economic data all this week. So I thought, what better for a 3 for Thursday to break that down, look at what the Fed did, look at what we're seeing from a inflation perspective, what we're seeing from a real economy perspective. So that's what we're going to talk about today, the Fed, inflation, and what's happening in the economy. Let's go ahead and look at what the Fed did yesterday. The short and dirty of it is they didn't do anything. They actually paused, which was not that big of a surprise. I think a little bit more of a surprise is what they signaled for what may lie ahead in terms of rates for the remainder of this year. So the chart here, the blue lines show where the Fed was signaling rates would end at the end of the year as of the March economic projections, a March dot plot. The consensus was pretty much that they'd be at 5% at the end of the year. That's where they are right now. Orange line here is what the market is thinking, based on what happened yesterday, where the pricing for futures for the end of the year. Then the green bar is that shows a distribution for the dot plot as of yesterday's meeting. And so you can see from the blue reflects where they were yesterday. So most of the Fed thought they'd finish the year at 5 as of March. Now they're looking at it being close to 5.5%. So an extra 50 basis points of tightening. So 2 more rate hikes over the course of the second half of this year. I was in the camp, probably one more. This is a bit more hawkish than I was expecting. The market has caught up to where the Fed was. So you kind of weight all these the distribution of expectations here, and the market now is where the Fed was as of March, but both of those are more dovish than where the Fed is signaling they're going to have to take rates over the second half of this year. So the question is, why do they feel like they need to continue to raise rates? And that takes us right into the discussion of inflation. CPI data came out earlier this week. Headlines were all about how headline inflation's coming down. Year over year change in CPI had dropped from like 9% down to 4%. This, it was slowing faster than it accelerated. Lots of excitement over that. The problem is headline CPI doesn't really tell you much about where inflation is headed. It's noisy. To get a sense of where inflation is going, you want to look at the median measures. Here we've got median CPI updated as of with May data as of earlier this week. Year over year change still just shy of 7%, even a 3-month change. So just what's happened over the last 3 months, it's running at a nearly 5% annualized rate. So the Fed's fight against inflation, even though the headline numbers are more encouraging, there's still work to be done. The top here, that's the median PCE. It hasn't been updated with May data yet. So this is as of April. 12-month change hadn't really rolled over at all, running at a 4.6% annualized pace over the past 3 months. So these median measures, not the ad hoc add this, subtract that measures that you see all over the place right now. These median measures that we've looked at for a while that were actually signaling elevated inflation heading into mid 2019, even though the Fed was cutting then, beneath the surface, there was still more inflation than they were acknowledging and accepting. Those measures that anticipated the surge of inflation, I think, suggests that we've still got more pressure out there than maybe the headlines are suggesting. The risk is that as the Fed is continuing to tighten and as it's trying to bring inflation down, some of the weakness beneath the surface of the economy starts to show itself. Nominal data, so adjusted for, that reflects, what happens at the cash register, that, activity plus inflation, that continues to be strong. Here's retail sales. That data was released this week, ticked higher in May, near its all-time high. It recovered nicely from COVID and has been strong ever since then. You take away the effects of inflation, and so not what people are paying, but what they're getting. And retail sales haven't grown in 2 years. It's been sideways. So inflation provides this veneer of strength, this illusion of robustness. Beneath the surface, you don't see that same sort of strength. And it's not just the retail sales data that is showing this. If you expand it to be all business sales, so retail and wholesale sales, it's falling on a year over year basis. Industrial production falling on a year over year basis. Truck tonnage data, so the amount of goods that are being shipped around the country falling on a year over year basis. Weekly earnings falling on a year over year basis. Um, you know, weekly paychecks no bigger on a real basis, no bigger now than they were prior to COVID. So yes, there are pockets of resiliency in the economy. We still see jobs being created. There's a labor shortage, so that's going to continue to persist, I think, for some time. But indicators of activity, especially when we take away the effect of inflation, have really started to slow. So the risk going forward is while the Fed is having to tighten to reduce the inflationary pressures, at that point, then the market sees the weakness that is actually present in the real economy. Right now, the market's looking past that. Stocks are rallying. Trends are improving. Breadth is trying to get in gear. Investors are feeling more optimistic about the market. But from a macro perspective, when we look at liquidity, when we look at earnings and valuations, when we look at economic fundamentals, plenty of risks still out there that we don't want to overlook as people get excited about the trends that they're seeing and the headlines that they're seeing on a daily basis. So that's three for Thursday. We got some supplementary charts that I'll include in the chart pack to show some of those economic data points I mentioned. But we'll leave it there for right now. Thanks for tuning in. Three for Thursday. Willie Delwich. Thanks for listening. I'll talk to you again next week.